An investment in knowledge pays the best interest is a quote that's often attributed to Benjamin Franklin. And whether or not it's strictly speaking true in all circumstances, there's no denying that there is truth in it. A better understanding of a subject, even if that subject is yourself, can help us to make better decisions and avoid the most costly mistakes that are within our ability to control. With that in mind, today I'm going to be talking about 4 common financial motivators that drive our money-related decision-making based on the investing personality types created by Tyler of PortfolioCharts.com, as well as how each of them play into what paths are most likely to lead us to achieving sustained financial success, not to mention greater peace of mind. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a 30-day free trial of Audible and 2 free audiobooks of your choice, as well as a list of some books on money I'd recommend checking out with your free trial. The 4 motivators behind financial decision-making, at least according to Tyler, are theory, proof, trust, and a desire to make an impact. Each have their own strengths and potential blind spots, so within each section we'll be discussing those as well. The first motivator behind financial decision-making is theory. People who primarily fall into the theory camp tend to seek out the opinions of others, but particularly experts, in order to build mental models that help them make choices that they feel comfortable with and set themselves up for future financial success. If you find yourself regularly poring over academic research when faced with big financial decisions, you may fall into the theory camp, especially if you would have otherwise felt fairly uncomfortable with a financial plan that you hadn't been able to thoroughly research and understand beforehand. For theory-based decision makers, the research process and having all those questions answered, even if those questions are minor in the grand scheme of things, is the thing that helps them feel more comfortable with the plan. Some strengths of theory-based decision-making is that they tend to be very knowledgeable about the subjects they've spent time looking into, and they also tend to be pretty adaptive to changing financial circumstances due to the wide variety of strategies and contingency plans that they've accumulated over time through their research. In other words, they're kind of like fine wine. They get better over time. Some potential blind spots for those who fall primarily into the theory camp is the potential that their mental models are based on incomplete or outright inaccurate studies or data sets, which can lead to a dangerous scenario where the individual is highly confident and comfortable with their approach to a financial problem, even though it is ultimately doomed to fail. There's also a chance that they could fall for a few cognitive biases, specifically confirmation bias and/or expertise bias. Confirmation bias is our tendency to seek out information that confirms what we already believe, or be dismissive of information that we come across that disconfirms what we previously believed. As you can imagine, that can lead to those problematic mental models that I mentioned a minute ago. Expertise bias is the tendency to be more trusting in individuals or organizations that have ideal credentials, even if the ideas that they're putting forth don't hold up to scrutiny. So some keys to being a successful, long-term, theory-based financial decision maker is to be vigilant with the studies, data sources, and people that you are using to help build your mental models. Some common strategies utilized by primarily theory-based decision makers are value investing, options trading, financial forecasting, and setting up bond or CD ladders to match your income to your expenses. According to Tyler, the second motivator behind financial decision making is proof. Those who primarily rely on proof to guide their decision-making often find themselves looking back at history to learn what did and did not actually work, contrasting them with theory-based decision-makers who often find themselves looking forward. But similar to how the process of researching various theories can help make the theory-based decision-maker more comfortable with a plan, finding a bunch of different real-world examples and analyzing them using a variety of different metrics can help the proof-based decision-maker more comfortable with plans that they create. Evidence of success in areas that the individual considers to be relevant to their situation is the key to getting comfortable. Some strengths commonly associated with those who fall primarily into the proof camp is their ability to replicate the success of others. After all, if you manage to find and implement strategies that work reliably for a large number of people and in a large variety of situations, then assuming that the strategy can still reasonably be expected to meet your needs in your own situation, you significantly increase your odds of achieving achieving financial success. But the potential downsides are equally obvious. If the individual does not have good data to work with, or they choose to ignore some of the data that they do have in a way that materially skews the results, whether positively or negatively, or they utilize the data in a context that isn't relevant to the decision they're trying to make, or heck, even if they just misinterpret the results of the analysis, they can wind up making decisions that are later regretted. For instance, it's possible that the individual fails to adequately consider how a plan that does have a historical precedent of a success aligns with their own personality, tendencies, risk tolerance, and other specifics of their situation. It is entirely possible to have a solid strategy nevertheless fail due to being applied in an ill-fitting situation. The whole debate between the debt snowball and debt avalanche is a great example of this. Both strategies in a vacuum are solid if followed from start to finish, but some people will find it easier to stick with one over the other. Others yet will find it easier to start with one, but then switch to another at some point during the payoff journey. So some keys to achieving sustainable financial success for proof-based decision makers comes down to having a solid understanding of what decision you're actually trying to make so that you can choose a relevant data set, having a solid understanding of yourself and your partner if you have one, and ensuring that the historical data you're analyzing to help guide your decision making is complete and not skewed or otherwise full of errors. Finally, resisting the urge to cherry-pick the data to come up with an easier or quicker solution must also be avoided. Proof-based decision makers excel in replicability, but getting to that point can sometimes take a lot of time, effort, and sifting through a lot of sources that ultimately end up being not very helpful. In short, patience is a virtue. Unsurprisingly, the most common strategy utilized by proof-based decision makers is backtesting. However, it isn't the only activity that they may find themselves conducting. Some who would also occasionally dip their toes into the theory end of the motivational spectrum, as none of us are going to fit into any of these camps all the time, may find themselves analyzing the histories of various strategies like the dividend aristocrats, and sorting those stocks to find top performers in certain metrics, such as those with the highest dividend yield, those with the largest dividend growth, or those with the longest history. According to Tyler, the third motivator behind financial decision making is trust. Those who primarily find themselves falling into the trust camp will often seek validation from others. Perhaps there's a financial personality that they have a lot of common ground with, and they'll regularly check in on when facing major financial decisions. Maybe it's a friend or family member whose expertise they trust. Whatever the case may be, one thing is clear with most trust-based decision makers. They're very self-aware and understand their own limitations. That doesn't mean that they aren't working to improve themselves, but they understand where they stand at the present moment, and they have the humility to admit it to themselves and reach out for help when it's needed. This can lead to a truly huge potential strength for trust-based decision makers. They are, at least in theory, able to crowdsource the expertise from the collective knowledge of everybody. This wisdom of the crowd's approach may not always lead to the absolute best solution, but it does often lead to solutions that are pretty darn good. And assuming that the circle of people whom you've placed your trust in are decent, it can help you to avoid many pitfalls that you may have never seen coming, financially and otherwise. A potential downside to being a primarily trust-based decision maker is that it is possible to put too much faith in the views of others. In theory, one of the appeals of being a trust-based decision maker is that it removes some of the personal pressures associated with making large financial decisions. When the experts are giving sound advice, or in the case of markets, just maintaining their sanity, that can work well. But other times you could get caught up in hype cycles or doom cycles that eventually bury you. We've seen enough rug pulls in the last few years to know how that story goes. So some keys to achieving sustainable financial success as a primarily trust-based decision maker is to ensure that you avoid falling for the trap of hero worship, where you begin to see an expert as more knowledgeable and capable than they really are. Also, make sure to seek out disconfirming information, especially whenever something you've been told sounds too good to be true, and ensuring that your desire to hear the inputs of others that you trust does not turn into an excuse for you to defer responsibility for your own choices and your own role in achieving financial success is also crucial. If you find yourself regularly acting on stock tips from friends, utilizing human or robo-advisors to help manage your portfolio, or following the recommendations from a newsletter, podcast, or show, you're probably a trust-based decision maker. According to Tyler, the fourth motivator behind financial decision making is the desire to make an impact. When making financial decisions, most of us are primarily concerned with what is the most optimal choice in terms of allowing us to make or keep as much of our money as we can. But that's not the case for all of us or for all decisions. Many people have a strong desire to make a positive impact with every financial decision they make, from what investments they choose. For example, funds that are more environmentally friendly might be more appealing to this group, even if their historical or projected future returns are believed to be slightly lower than some of the alternatives at the time, to things like how they choose to pay off their debts. Some version of the debt tsunami might be quite common for people that fall into this camp. And, of course, where they choose to spend their money. One of the strengths of this camp is that they tend to have really big hearts. And because their primary focus is not always about just maximizing profit, it is easier to find opportunities to more deliberately make a positive difference, whether on an individual or even societal level. That's not to say that those who primarily find themselves in the other camps can't also make a positive difference on a regular basis, because of course they can. It's just that those who find themselves primarily falling into this camp tend to weigh that aspect of the decision a little bit heavier than most others. Another strength is that the impact-based decision makers tend to be able to ride out the tough times pretty darn well, because even though going through those times is still hard, they at least feel good knowing that their efforts are making a difference. A couple of potential blind spots to keep an eye out for if you are one who primarily falls into this camp is the potential of being a target of emotional manipulation, and the potential of losing perspective on what the goal actually is. So remember what impact you were trying to make with your decision in the first place, and ensure that as time goes along, you keep an eye out for opportunities to better and more efficiently achieve that goal. Success may look a little different for impact-based decision makers than for some of the other camps. As a result, perhaps the biggest thing to strive for is emotional awareness and control. Again, impact-based decision makers tend to have very big hearts, and there are some people that will try and take advantage of that. But beyond that, we can also fall prey to being too emotionally charged on something to the point where we stop making good decisions. So again, developing a strong level of emotional awareness and self-control can help to mitigate those potential pitfalls. Now, why is any of this important to understand? Well, the answer is quite simple. People who do not understand their primary financial motivator can inadvertently put themselves in situations where they're setting themselves up to fail. This could come in the form of dissatisfaction with your life, in large part because you're not utilizing your money as effectively as you could, but you could also find yourself abandoning your strategies, often at the most inopportune times. For instance, a proof-motivated investor would likely struggle if they jumped into the meme stock craze, due to the lack of historical data to back up its effectiveness. In fact, the historical data for situations that sort of resemble the meme stock craze often suggests that it's not a very good long-term approach. However, for the right kind of impact-based decision maker, that could have been money well spent, even if they did ultimately end up losing some of that money on the investment. And finally, it's important to have at least a general understanding of what motivates us financially, because we're not in this alone. Understanding your primary financial motivator can help you to direct your energy and money more effectively to get more out of what you already have. That makes perfect sense. But it's also true that understanding the primary financial motivators of those who you are close with, particularly your partner if you have one, can be a game changer. It can help you to understand where they're coming from, for one thing, but rephrasing things that they say to you into something that speaks a little more closely to your primary motivator's language, confirming with the person that your translated message still matches what they were trying to communicate, of course, and vice versa, can do wonders for lessening the frequency of miscommunications, and in some cases, play a vital role in heading off financial arguments. If you want to see some examples of how you might translate some of the financial statements into various languages, definitely take a look at Tyler's article on portfoliocharts.com, which directly inspired this video and digs even deeper into this topic. He actually goes so far as to create a Myers-Briggs type indicator inspired financial personality system stemming from these motivators, which makes for a really interesting read. But for now, I think I'll leave it there. Those are the 4 primary financial motivators, at least according to Tyler. Are there any other motivators that you can think of? Which camp do you primarily fall into? And how has it helped or hindered you in the past? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. If you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.